Everyone online and everyone in person, thank you so much for joining us. My name is Houston Loke. I'm Executive Vice President of Market Conduct at FSRA, and I'm joined by my two colleagues who I'll ask to introduce themselves. Erica?
Good afternoon, everyone. It's great to be here with you today and to be a part of this discussion with Houston and my colleague Swati. My name is Erica Heemstra. Can you hear me okay? Is that okay? Okay. I'm the head of insurance conduct for FSRA.
Hi, everyone. Nice to see you all. And so many familiar faces. I'm Swati Agrawal, and I'm responsible for the supervision of life and health insurance companies and their distribution partners, and really looking forward to the fireside chat today.
Yes. So this panel is all about life insurance, and we're going to take a bit of a round trip that'll cover a number of areas. But what I'd just say is when we look at insurance, it's often easy to just consider it to be just like any other financial services product. And what I would say to you is that it is more than just financial services. It is a promise. Life insurance provides critical protection for individuals, for families, and for businesses. And it helps people make better decisions for their life. An insurer takes on some risks. So if you should pass away, then your beneficiary receives something. If you experience a covered peril, then you'll be able to have access to help. And you can worry less about those insured events and focus more on what's important to you. But all of that comes with a very important caveat. A promise rests on the assumption that the product that the individual has is important and is suitable. And so we're going to spend a lot of time this afternoon talking about suitability, talking about practices, and talking about ways that insurers, intermediaries, and agents can make that promise real. So with that, I wanted to just start by exploring, what is that promise and what does it look like? Erica, perhaps you could paint a picture for us. What are consumers looking for when it comes to life insurance?
Sure. I just want to check everyone can hear me. Okay, great. Okay. So as you said, Houston, insurance is a promise to pay. And in the case of life and health insurance, that's a promise to pay when something quite terrible may have happened, like a death or an illness. And that's happening to happens to a consumer or a member of their family. I'm just going to pause to make sure that our online folks can hear us okay. I'm assuming I'm loud enough for the room, but okay. So what consumers want in life and health insurance is certainty that they're covered and that their claim will be paid should that terrible event occur. I personally had a great experience when I needed to buy life insurance. My agent followed needs-based sales practices, and I bought a suitable product that's actually still in place and serving me and my family today. And given that this all happened almost 10 years ago, I also know that I didn't just have a positive experience because I happen to work for FSRA today. Importantly, my story helps to demonstrate the link between needs-based sales practices, product suitability, and fair treatment of customers. So fair treatment of customers is really the guiding principle for FSRA in the insurance sector. And the concept guides our supervision priorities, our policy development, and our enforcement activities. Of course, we understand that insurance is a sales-driven industry and policies sold are a key success measure for growth. But fair treatment of customers helps us to remember that behind every policy, there is a person and often a family with their own story and reason for needing insurance. And I would say from our principles-based regulation panel this morning, fair treatment of customers really serves to align the interests of consumers, agents, intermediaries, and insurers, as we heard this morning. Consumers expect life agents, intermediaries, and insurers to treat them fairly. They expect them to be duly licensed, qualified, accessible, and to conduct themselves in an ethical, professional manner before, during, and after the product sale. Not everyone has the same experience that my family did. And so FSRA's market conduct team monitors agents, intermediaries, and insurers, identifies risks for consumer harm, and conducts supervisory examinations of adherence to the Act, rules, regulations, and guidance. And adopting that culture of fair treatment of customers not only helps the industry to comply with regulatory expectations, but to stay focused on protecting consumers in their time of greatest need, which is the ultimate purpose of these products. Now I'll turn it to Swati. Swati, to support fair outcomes for consumers, FSRA's key supervision initiatives in the last few years have focused on overseeing that end-to-end distribution of life and health insurance products distributed through independent channels. Why have we focused our efforts in that area?
Thank you, Erica. I think everyone can hear me okay. So when FSRA launched, we wanted to look at the entire ecosystem. We wanted to look at the entire sales process. We wanted to look at conduct from a multitude of different angles. And that is where our journey started. So our journey started not just to understand one element within the marketplace, but our journey incorporated the different layers and players in the marketplace. And that is what we call as end-to-end distribution. So we started with insurance companies. They are at the top to understand how is it that they are implementing fair treatment of consumer principles. I mean, if we ask each one of us, what is fair treatment of consumers? It can seem so abstract, but there's a consumer in each one of us, right? So it was about understanding that consumer journey. It was about understanding how products are being designed, distributed, and to go through the entire product life cycle till the claims related obligations arise with the insurance companies. So we examined, tier one insurance companies because they had the maximum market share and they have the maximum market share. We covered approximately 70% of the market share. And that is where we understood the challenges that the insurance companies have when it comes to implementing the principles of fair treatment of consumers. And as a regulator, we want to help address those challenges. And one of the largest, concentrated areas of challenge that we found when we were working with insurance companies is that distribution has evolved, distribution has changed. And with the evolution of distribution, and I see so many nodding heads, with the evolution of distribution, it became very challenging for the insurance companies to maintain that relationship with their intermediaries and basically to be able to assess how roles and responsibilities are divvied up between the insurance companies as well as the intermediaries. We saw there was a delineation of roles and responsibilities. And when that happens at the top, it has a cascading effect down to the consumer level, right? So which is when we decided to get into the second chapter. And our second chapter was to understand the relationship between the insurance companies and the intermediaries. We covered insurance companies that represent approximately 50% of the market share. And we understood that there are some systemic gaps in the marketplace when it comes to designing that relationship, and more so when it comes to execution of multitude of important key market conduct activities like screening of agents, training of agents, monitoring of agents, and those activities that are delegated. You all have seen our reports. We've published it in the spirit of transparency, in the spirit of creating that awareness in the marketplace, in the spirit of public protection. But when we were doing the second chapter, we actually saw a concentrated risk, a potential perceived risk about a particular type of a business model that uses a tiered recruitment model. And we saw that risk from a multitude of different angles. We saw that risk because of the LARFs that we were receiving. We saw that risk because of the consumer complaints that we were receiving. We saw that risk because of the insurance companies that we examined and the gaps we saw when it comes to overseeing tiered recruitment models. And that is when we did our third study. And I think Mark spoke adequately well about our third study. That is when we actually went out and reviewed 3 MGAs. and really understood what are the gaps, when it comes to overseeing the agents when they are operating in such kind of a model. And again, we have a report which we've released, which covers, all the different findings. So what I want to explain is that, we've had a journey, as I said, which started with insurance companies, went on to the MGAs, went on to specific models of the MGAs, but that journey doesn't complete without us reviewing agents. And we have Robert Pryor, who's the senior manager for agent supervision here. And that is where the point of sale happens, right? So that is what our next segment was, to understand what is happening at the agent level. And end-to-end distribution is one thing, but it's also important to understand that, being a regulator, I tell my team, it's like driving a car. You have a rear view mirror, you're constantly looking into what you're learning and you're, going ahead, marching ahead, but you have different wheels. You have the supervision wheel, where we go out, we collect the empirical evidence, we collect the data, we see what is really happening on the ground, but that's not the only wheel that we use. Through all this study, we've taken the supervision wheel and we've combined it with the policy wheel. We've understood, how this data, this evidence can help us in developing our guidance. We've used that to develop our enforcement wheel. Of course, you won't enforce on anything, but we do have symbolic enforcement to be able to act as a deterrence factor. And the last wheel is the communication wheel, because we can do the best work possible, but if we don't create that awareness, we can't create that change in the marketplace and cannot really help the consumers to educate themselves as well, right? So it was like driving a car. And also when you're driving a car, you're just not driving alone. There are multiple other cars on the road. And for us, that's all of you, our stakeholders, our technical advisory committee members, our consumer advisory panel members, so that we can all function together and synergize our efforts to get the best possible consumer outcomes. So that said, I did point out to Robert, but Erica is going to cover the last segment of what is it that we do when it comes to agent reviews. Erica?
Thanks, Swati. I'll start with when Robert joined FSRA in the fall of 2020, and just tie this into the fact that in life and health insurance, life agents are really the cornerstone to providing consumers with advice and access to insurance products. And in March 2022, FSRA published its Life and Health Insurance Agent Supervision Framework. Robert and his team have spent the last couple of years building the framework, and now we're in the process of actioning that framework and maturing it. So that framework really does take a risk-based approach to ensuring that life agents in Ontario are subject to proactive supervision, while promoting transparency and disclosure of information and deterring deceptive and fraudulent conduct practices and activities. This is very important, as there are, I think now, over 60,000 licensed life agents in the province of Ontario. So being risk-based and sharing what we're seeing, being transparent about what we're seeing in the marketplace, are key to effectively supervising the sector. So to date, our proactive supervision activities have included thematic examinations based on risk indicators that we see in the industry. And the outcomes of those examinations have varied. And there are a number of tools that we use to deal with non-compliance with regulatory requirements. I'll just give you some examples from 2021, 2022. We conducted 163 agent examinations. In 27% of cases, we did escalate to our regulatory discipline officers for an administrative monetary penalty. And in 25% of those cases, we issued warning letters identifying industry best practice non-compliance issues with the agent. I would say this second point is very important. Examining for best practices that reflect needs-based selling does tie directly to treating customers fairly. Expectations and non-compliance with best practices is a concern for FSRA. When best practices are not followed, it does raise current concerns about how agents are conducting themselves in the marketplace and what sort of industry oversight they're subject to. Looking ahead, We're finalizing our 21-22 life agent supervision report, and the highlights of that will come out over the next couple of months, along with the outcomes of the annual LARF examination report. So this publication will raise awareness about the issues we're seeing and support a dialogue on what the appropriate responses should be from both the conduct supervision and public policy perspectives. I would say that summarizes our approach at the agent level. Of course, this work is integrated with our other supervision efforts in the sectors in terms of both supporting insurer and distribution chain reviews, or using the outcomes of the agent reviews to risk inform our other supervisory activities.
Perhaps what we could do, we are going to talk about segregated funds, but before we do that, I would love to go back to the discussion we started, Swati, on MGAs. In particular, just not everyone may have been aware of all the findings. Perhaps you could identify the 3 to 4 key findings that came out of our most recent review of the tiered recruitment MGAs.
Thank you, Houston. When we started, the MGA journey, as I said, it was because we saw a delineation of roles and responsibilities between insurance companies and intermediaries. And MGAs, of course, are the most pervasive distribution channel in Ontario. 67% of the independent agents that work in Ontario, they work through this MGA channel. So FSRA embarked on a review, and we led it for CCIR. The most recent review, we had 5 other jurisdictions participating with us. It was our first time review, and it was a review that we led for the country as well. When we led this review, there were 3 or 4 findings that really stood out to us. What we saw, and of course, we had our focus on the tiered recruitment model. And tiered recruitment model is where you hire multiple agents, and every agent that you hire, the sales that are being made by that agent, you get a split commission of that recruited agent's sales as well. So our findings were that in the marketplace, we saw that the expansion of these MGAs is happening at a very fast pace. So if you were to look into the numbers, in 2020, 2021, the number of agents that expanded only in Ontario ranged from 50 to 70%. And if you go back 4 years, 2018 to 2021, it was in the range from 55 to 119%. So you can imagine the significant influx of the agents which is happening in the system. And the 3 MGAs that we reviewed, they represent approximately 21,000 agents in Canada and 11,000 agents as of the date of our review, which is approximately 20% of the agents in Ontario. So they're expanding at a very fast pace, 1. 2, relatively complex products are being sold by these agents. I'm not saying all products sold are complex, but relatively complex products are being sold with that rate of a high influx. It's okay to sell relatively complex products, but the due diligence that happens when relatively complex products are being sold needs to be higher. And we did not see that due diligence in our review. So point number 3, a lot of training that we saw, it lacked substance, it lacked rigor, and a lot of training that we saw fundamentally did not even align with the fair treatment of consumer principles. And if we all think of ourselves as a consumer, don't we want to receive the most accurate information to be able to make a decision when it's a promise, when it's a security, when it's some kind of comfort, just sleeping at night knowing this is for me and my family, right? And the last thing is monitoring. You can have the best attestations in the world, but you need to monitor the agents, and you need to know whether what they are attesting to is actually taking place in the marketplace, right? We saw insurance companies, they delegated a lot of the monitoring function to these MGAs, but we did not see any evidence of these agents actually being monitored in a meaningful way or in a way that is proportionate to the way they are expanding. So what we are trying to say is, FSRA is definitely an innovative regulator. We are not trying to hamper growth, but that growth has to be measured. That growth has to have the right checks and balances in place. And that growth, has to be balanced with how you monitor, and there has to be some proportionality to it. And that is what was missing. So that sums up what we've seen in general terms from the MGAs that we've reviewed, but the work doesn't stop there. As I said, it's about end-to-end distribution. So Robert's team is going to these same MGAs and examining 130 agents from these MGAs to understand that, is this a systemic problem at an institutional level, or is the impact even being felt by the consumer at the point of sale? My team is going to some insurance companies that are sponsoring these agents, that are working very closely with these MGAs, again, to understand that, is there any kind of a breakdown that happened at the tone at the top for all of these issues to surface up? And when we are doing this, I heard from so many of you that please focus on regulatory harmonization, work with other regulators, reduce the burden in the marketplace. I'm very happy to let you all know that we are 9 out of 13 regulators who are working together on these insurance company reviews, and FSRA is leading that. So as they say, energy flows where the attention goes. And I think we have the right attention in the right places, and all of you can feel that energy of change for the good for the consumer, right?
So Swati's mentioned our supervisory work on MGAs. You mentioned our work on insurance agents. We're also engaging in supervisory work with insurers. And you got a taste of what some of the issues were from the 4 or 5 points that Swati identified. As you can see, we have some serious concerns. And we will use all measures available, whether it's supervisory compliance, whether it's enforcement, whether we need additional policy tools, whether we need to communicate more, whether we need to listen to complaints or whistleblowers. We will use all of those tools because we feel it is essential that customers receive fair treatment, and because we're very concerned about some of the practices. So that's on the end-to-end distribution and MGAs and life agents. Would like to switch gears and talk about segregated funds. Now, segregated funds also contain a promise because there's a death benefit, there's a floor value after a certain period of time has elapsed. And FSRA, working with our regulatory partners across the country, has made some significant steps in terms of segregated funds. And I'd like to pass things over to Erica just to discuss what are some of the highlights there and what should stakeholders be looking for in terms of those changes.
Thanks, Houston. The segregated funds project can sound like something that's very complex, but I think it's actually important to boil it down to what is the intent of this work. It's crossing over a number of years. It's something we're trying to coordinate nationally through the CCIR and CISRO. And the end goal of the work that's being done here is to establish a national standard of care for the sale, servicing, and administration of segregated funds that does not exist today in Canada. And there are 4 active work streams. I'll just give you kind of the highlights of each of those. We have work going on to end deferred sales charges in segregated fund sales. So last year, many of you may recall that CCIR and CISRO announced that an end should come to new DSC sales in individual segregated fund contracts by June 1st of 2023. And to enable that in Ontario, we have proposed amendments to our UDAP rule, to our unfair deceptive acts and practices rule, to prohibit insurers from selling new individual seg fund contracts, and to introduce some customer protections that address the use of DSCs for all individual seg fund contracts, regardless of when the customer may have purchased them. This is really important when it comes to protecting the rights of consumers as well as their interests. And the approach that we're taking on DSCs in Ontario will harmonize us with the intent of the national statement. The other another stream of work that's happening here is on total cost reporting. This is work that's actually in harmonization with the work being done by the Canadian Securities Administrators. And the point of this work is to improve and harmonize ongoing disclosure of the total amount consumers are paying on mutual funds and segregated funds, including embedded fees, And in particular, total cost reporting highlights indirect costs that are paid from assets held in the funds. And those are costs that wouldn't necessarily be visible to consumers, but can reduce their return on their investments. In terms of timing, this coming spring, the CCIR intends to release the final guidance on total cost reporting requirements. We also have work underway on upfront compensation in segregated funds. That's different from the deferred sales charge cessation, and this primarily deals with the advisor chargeback method of compensation. So CCIR conducted a consultation on that, and now with our CCIR partners, we're analyzing the information and submissions and data that we've received from industry and stakeholders, and we'll be moving forward with a policy position on that later this year. Finally, and this comes back to putting that standard of practice in place, or a standard of care in place for consumers. The final work stream here relates to what we're calling the market conduct chapters, but that essentially is CCIR and CISRO guidance that will establish conduct standards for agents, intermediaries, and insurers with respect to the sale and servicing of segregated funds. So that will include things like having requirements around know your client, know your product, needs analysis, advice giving, and appropriate documentation to ensure that we have suitable sales for consumers when they are looking at buying IVIX. And that is sort of the work in a nutshell. What I'll do, I think, is pass it back to you, Houston, to keep us going.
Okay.
Can I ask a question?
Yes.
So Houston and Erica, let's start with you. What do you think success is from a consumer standpoint?
It's a good question. Thanks, Swati. I would say if we're looking at fair treatment of customers in insurance distribution, it's really, again, it's a simple concept, right? This boils down to having the right people selling the right products to consumers at the right time in the consumer's life. Success from a customer perspective then is seeing continued value in their insurance coverage and having trust in their agent and their insurer. They need to understand what their coverage provides and that they have, we had some interesting comments, I think, from the consumer panel this morning on how you can actually engage with consumer where they are to make sure you have their attention and you have them engaged so that they really understand what you're providing to them through these products. I would say from a consumer protection perspective, a sign of a success is a regulator that can proactively use data and analytics to identify and take action in areas where there's the greatest potential for consumer harm. And wanted to leave you with a few parting thoughts on what we're doing through the efforts of Robert's team on agent supervision. So recently, the Life Agent Unit has focused on data analytics and machine learning abilities for predicting risk indicators associated with life agents. And these new regulatory tools are supporting the ability for the unit to conduct targeted examinations. So in one example, the team found an outlier from the lapse rate data that's reported in the annual statement on market conduct and examined certain life agents in relation to this risk. Through the examinations, best practices issues were found, as well as contraventions with the Insurance Act. Further, suspected conduct that uses coercive selling behaviors involving unregulated value add products to obtain policy sales also emerged. And that last point is really the new piece to this work, that the team, through the targeted exam, was able to surface that sort of potential behavior. It's really peeling back the layers of the onion approach so that we can focus our efforts on the areas of highest risk to identify conduct behaviors that would not otherwise have surfaced in an examination. So clearly, the example in this case does create potential for consumer harm, and those examinations are continuing by the team. That's really where we think we can achieve the best success for consumers from a consumer protection standpoint. Swati, can you comment on success from a regulatory perspective?
Okay, this is a fun segment. Success, who doesn't like to talk about success? My son was asking me that, do you think you can become the CEO of FSRA one day? I said, what are you even thinking? I'm just not that bright or intelligent. And he said, that's because you focus too much on perfection. If you have to move ahead, you have to think about progression and not perfection. And he was only 6.5 when he told me that. And so I have kept that at the back of my mind, thinking that perhaps what he's saying is not wrong. As a regulator, can we say we are perfect? No, but are we progressing? Yes. And what is it that is progress? For me, it's the 5 C's. My first C, courage. Are we demonstrating courage? Yes, we are going into new areas, we are going into new territories, we are creating new pathways, we are demonstrating courage. That's a sign of success. 2, competence. You want to go in a new area, but are you developing the skills to go to the new area? Are you ready to do what it requires, have the alma mater to go into the new area? And yes, we are developing our competence, our knowledge base to get into, many different areas to collect that empirical evidence and to actually drive the change, not just from a supervision perspective, but as I said, from a policy perspective, from an enforcement perspective, from a communication perspective. 3, communication. As I said, you can do the best work, but if it's not communicated adequately, if it's not transparent to the industry, success doesn't happen. All the different elements of journey that I spoke about, you've seen that we've published our results. We've engaged with our stakeholders. There's been discussions with our SACs, TACs, CAPs. We are constantly talking, interacting, having that dialogue, because we don't want to be in a regulatory bubble. And that is what communications and transparency, and that's what Houston taught us, from day one. The importance of publications, the importance of having that transparent interaction with the industry. 4, consistent framework. As a regulator, you don't want the industry to be second guessing what the regulator is thinking every day. New issues come up every day, but are we operating against a consistent framework? The answer is yes. Consistent framework is end-to-end distribution. Does that mean we don't look into new challenges? No, new challenges come up on insurer front, on MGA front, on agent front every day, but the industry knows that the regulator is operating against a consistent framework. And 5, I would say, is compass. As a regulator, our compass always needs to point north, and our compass is pointing towards what's best for the consumer. So consumer centricity drives our compass. So courage, competence, communication, consistent framework, and compass that points towards consumer centricity is what we've done, what we will continue to do. And that, I think, don't you all think, will make us a successful regulator? Yes. So Houston, we spoke about consumer success. We spoke about regulatory success. What does overall industry success look like?
I find it so interesting because industry success, consumer success are so close to each other. If consumers feel that promises are being kept, if consumers feel that they are now able to access suitable products that meet their needs and help them provide protections to themselves, their families, and their businesses, that can only be successful for industry, for the insurers, for the MGAs, and for the agents out there. And that is what we as a regulator are looking for. How will we get there? It will include a combination of responding to risks, looking at the highest risks of misconduct out there and holding those entities to account using a combination of compliance, enforcement, and policy tools. It will also mean that we have to monitor the overall risk landscape. What else is new? Swati mentioned that the method of distribution had changed over time, and the regulator has to adapt to that. what other changes do we need to adapt to? They might be in segregated funds. We've got additional work going on in terms of ombud services. We of course are on the lookout for additional risks in other areas for insurance distribution. But I think that consumer and industry success is just so close that they cannot be separated. I think that it's a testament to the efforts of everyone in this room to try to make sure that consumers are experiencing that success through promises that are kept and through suitable product. So I think that takes us to the end of our prepared remarks. If we could, we start a few minutes late, so I'd like to go just a few minutes over so that we can take perhaps a couple of questions from the room, if that's possible. Anyone with any questions? Perhaps not. Yes. Yeah, sorry.
Just thinking of the folks online. I know you did touch upon this, but harmonization is always something that we're very concerned about in the industry. I was pleased to hear Swati mention that your investigation of the MGAs occurred under the auspices of the CCIR and with other jurisdictions. And I was just wondering if you could tell us in 2023 what additional efforts you see yourselves perhaps making as Canada's regulator of the largest province in terms of trying to encourage harmonization, which is so important in terms of efficiency and achieving, our common objectives.
That's a great point, and thank you for raising it. What I'll say is this: the insurer exams that Swati and team have been involved in, every single one of them has involved multiple jurisdictions. The reviews of MGAs that the team has been involved in, every single one has involved multiple jurisdictions. CCR is the forum for Canadian insurance regulators. We have play a very active role, and all of the work on segregated funds that Erica spoke to is being done on with our CCIR partners. We know that harmonization is important. Where there are some occasional differences of position, then we will deal with those on a jurisdiction by jurisdiction basis. But on the vast majority of circumstances, we are going to do our very utmost to come up with a harmonized approach.
First off, love that you guys are taking a look at the chargeback funds. We're excited about the DSC going away, but then they came out with something that sort of smelled the same. So thank you for that. My question is, have you looked at, so in the US, you have to have a different kind of license if you're going to sell a variable product. And as you review MGAs and suitability of product and whether the advisor is trained, have you considered that having a certain kind of training or education would be more appropriate if you're going to be selling more complex products?
Go ahead.
I'll start
Yeah,
and
sure.
then Houston can jump in. So of course, right now, your standard for getting licensed as a life insurance agent in Ontario is that you would have to successfully complete the LLQP and then become FSRA licensed. The LLQP does include a segregated funds course. And in fact, we're looking at revising and updating that course. It'll have to be done in order to reflect the new requirements coming in the guidance. So that's one way we'll be looking at enhancing it with respect to that particular complex product. And Houston, I don't know if you've got anything to add to that piece.
I know it's going to also point out the continuing education piece. And also there are multiple projects, all of which are on the seg fund piece, to ensure that where the consumer is involved, they will have additional information in the form of cost, and they will have additional, and there's additional guidance that CCR has put out in terms of things like sales practice, or that is going to be, CCR is going to be publishing additional sales practice guidance to ensure that consumers have the information they need. At this point, we are not working on a multiple tier licensing system, but we believe that the policy measures that are under development will go a long way to protecting investors.
Okay, thanks.
Thank you. Okay. Oh, sorry, one more question.
So, like segregated fund is actually an investment product, but built under the insurance law to give a better protection and others. So, the current LLQP license doesn't empower or doesn't give knowledge about investment to the agent. Whosoever is LLQP license, they know nothing about investment. The course doesn't cover, and the product providers and MGA doesn't train. So everybody who is selling segregated funds are just selling it, and everybody else is getting paid. Only the consumers or the customers are not getting paid. That's it. From my point of view, anybody who is insurance license and they want to do segregated fund, they should go through a different licensing process just to understand the product and give the advice to the consumer what they need, so that they are able to give investment advice. Insurance advice and investment advice are totally different. It should not be under one course or a one LLQP license. It should be separate license. That's my perspective.
Yeah, no, thanks for that input. And I think we can take that away and consider, what possibilities there can be from a proficiency and continuing education perspective. Okay, I know we are at time, so I wanted to thank all of you once again for attending. For those of you attending online, thank you for participating. For those of you in the room, it's our pleasure to host you. Thank you, and we hope you enjoyed your day.